Fung is a Hong Kong-listed sourcing agent that helps US consumer brands manufacture in Asia. Since 2015, times have been tough. Their revenue's fallen 38% and the stock is down 90%, leading to a market cap of under $1 billion. Recently, they sold a 22% stake in their logistics business for $300 million, which cut their net debt to less than $200, and so we thought we should take a look. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. Fung has a worryingly high governance, accounting and peer performance score. Their balance sheet looks particularly odd and worthy of investigation, and running the company through our standard GAAP analysis, we noted the following. Governance. The board includes 3 family members, a couple of employees and what look to be some friends, none of whom are obviously independent. There is one director who might be, but he's worked at General Electric, which we don't find very reassuring. This lack of independent directors is a problem because the company has significant trading relationships with both the family and other group companies. The relationship with Hong Kong-listed global brands is actually our biggest concern, but I'll deal with that under accounting risk. Accounting. Liquidity and credit control are vital for any trading business and become even more so when revenue drops. Now, Fung superficially looks quite healthy today, with modest net debt following its various asset sales. However, we think that their interest costs imply that day-to-day debt is much higher than is reported. We also worry that their working capital continues to absorb rather than release cash when revenue is falling. This is the exact opposite of what we'd expect. But the elephant in the room is the large related party receivable. We think this is largely owed by global brands, which is a concern because we think global brands may be insolvent. If this is the case and it goes into default, Fung could collapse. Performance. As we mentioned, over the last few years, Fung has suffered along with its clients. Revenue has fallen and, although gross margins have held up quite well, it seems they're struggling to cut overhead fast enough. The result has been that EBIT margins have halved. Now, first half 2019 operating cash flow turned positive, but most of this swing was due to the new rules around lease accounting. Remove that, and while cash flows improved, it was not enough to generate a positive business cash flow. This is because, despite the downturn, Fung has continued to pay out large dividends. The dividend has now been cut, but unless revenue can be rebuilt, we expect that profits and cash flow will remain under pressure. Most importantly, unless global brands can be turned around, the receivable risk remains, and with it, the potential for collapse. We can't comment on valuation, but we are surprised to see that their debt is still rated as investment grade. If you want to look at some of the issues we've covered, please access some of their recent filings via the links below, where we've highlighted some of the key points and where to look. If you'd like to know more about our research, please visit our website or send us an email. Alternatively, to keep up to date with our reviews, subscribe to the channel. Thank you for your time.